All right, what is up, everybody? We're back again today to talk about the fourth and final part of the stock market videos. So far, we've talked about, in the first video, about the stock market history, what it's all about, how it was formed. We talked about the financial statements, the information that you need to know to find and pick good companies. We talked about individual stocks and ETFs, which is really important. And today, we're going to talk about brokerages, my favorite brokerages, where to invest, and the things that I invest in. And then also price, how price is determined, how stock prices are determined, which is a lot of different ways, which can be all over the place. So just to start, brokerages. So say you want to go buy some stocks, you want to go buy your first ETF. Great, you're in the right mind. So what you need to do is you got to think about this like buying a brand new car. When you want to go buy a brand new car, what do? You need to go to the car dealership. You can't exactly just go to a Jeep plant, give them $30,000 to give you a car. Yeah, you can talk to the company and arrange that, order it through there, but typically that ends up happening through a dealership. So think about a brokerage like a dealership for stocks. So you need to go find a place online to where you can give them money, and then they can go out to the trading floor and buy the ETF for you, buy the stock for you. So brokerages, my favorite brokerage, Vanguard. Vanguard is a great place to invest your money. They've been around for a long time. They have over $2, $3, $4, $5 trillion of total investment money with them. They've been around for a long time, very trusted. And the reason I like them so much is because of their expense ratios. So when you think about brokerages, when you think about car dealerships, when you buy a car, in a sense, you're also paying the salesperson there. So with brokerages for investments, you have to pay what is called expense ratios. Sorry, I can think about that for a second. So expense ratios. So what this is say that you invest in an ETF. So this is only for ETFs and mutual funds. So say you invest in an ETF. They're going to have someone to manage that money, to buy it for you is going to cost some money. So say for the S&P 500 ETF that they have, which is VFINX, they're going to charge you something like 0.05% of the total assets in there. They're going to charge you expense ratio. Vanguard has the lowest expense ratios in the market. No, I'm not getting paid by Vanguard to say this, but this is where I invest all my money because my money that's in there has the lowest expense ratio. I'm paying out the less amount per year. So every year you have to pay a piece of your investment to the company, and Vanguard has the absolute lowest. So I love Vanguard. I think they're great. The second brokerage that I love, that I trust, has been around for a long time, also manages multiple trillions of dollars, is Fidelity. These are both American companies. I know Vanguard for sure is headquartered in Pennsylvania, been around for a long time. So Fidelity is our company, like I said, owns a lot of assets, has a lot of investable assets, been around for a long time, somebody you can trust. So they are really good also for ETFs, but what they're really good at is individual stocks, buying and trading individual stocks. So with individual stocks, they charge you $4.95 per trade, which is like industry low. So say that you buy some Apple shares, you buy it for $100. It's actually going to cost you $104.95. But they are the lowest. Vanguard charges something like $20 per trade. You know, other brokerages can charge more or equal to. Now, if you have a lot of money invested in Fidelity, they will cut this down for you. So say you have $500,000 of assets with Fidelity, they're going to cut this down to say 20 free trades, or it's going to be like $1 a trade. But really, Fidelity is the best, one of the best places and trusted places I trust my money with when it comes to buying individual stocks, just because their commission per trading individual stock is the lowest. And just like this, they do have expense ratios for ETFs, but they're a little bit higher. So what do I invest my money in? I invest all my money in exchange-traded funds into ETFs through Vanguard. This is not specific investment advice. This is my opinion. You shouldn't take this and run with it and go invest your money here. But this is what I do, and this is what's made me $5,000 so far. The two areas that I invest in are VFIAX, and I also invest in VGT. So what VFIAX is an S&P 500 ETF. So like we talked about in the first video, the 500 best U.S. companies that Standard & Poor's picks, and I invest in that. And on average, I did a study myself from 1929 all the way until current year, that'll return around 8% per year. Some years will be, like this year's 20%. Some years will be down. But on average, if you have your money in there for 5, 10, 15, 20, 25, 30 years, you can expect about 8% return on average year over year. So what I also do is I have money in the entire market, and I also have it in a sector. So VGT is a technology investment. So that just takes the technology industry. So we talked about the industries in the past video. It takes that industry and invests in it. I think about every 10 years you get hot industries. So I think technology's been hot for the past couple of years. You get industrials, you get this. But I invest my money here. This year it's returned 38%. On average, it's right around the same as the S&P 500 or maybe a little bit more. But during the time, I like to have my money diversified in the entire market. And then I like to have some of my money in an industry in which I think is outperforming the market, which is like leading the S&P 500. So that's where I invest my money. Lowest expense ratio is a great place to go. If you invest $3,000, which is the minimum for VFI AX, you're going to have to go into VFINX. So these two are exactly the same, except in order to be in this one, you need $10,000, and they give you a lower expense ratio. When you're first starting, you need $3,000. So if you don't have $3,000, you can go what is into VOO, which is the same thing as VFIAX. And that's another ETF that you can buy. And what that is that's to say that you have only $200. Like to buy a piece of this, you only need $200. You don't need the minimum of $3,000 for this one. You don't need the minimum of $10,000 for this one. You just need $200 to get into that same ETF that's going to show the same returns as this. So that's about brokerages. So Vanguard and Fidelity are the two best places to invest in my opinion. So price, we're going to talk how price is determined for stocks, ETFs, everything. Price is determined by a lot of different factors, but overall it's determined by supply and demand. But each of these are derived from a lot of different things. So just to take a basic example, say we have Apple. This is Apple's ticker symbol. So say they have 1,000 shares and they're currently trading at $100. So say there's 1,000 people who own this. All 1,000 people own that at $100. But in the US, there are 2,000 people that want to buy these shares. There's 2,000 people who are like, listen, I want to buy Apple. I want to buy Apple. So what is this guy going to do? What's going to happen to the share price? The share price is going to go up because the demand is higher than the supply. So there's less shares out there than what people want. So in order for these people to sell them, they're going to say, I'm not going to sell you at $100 because there's a lot of people to buy them. I'm going to sell it to the highest bidder. So what's going to happen is they're going to start selling at 105, 110, which is the bid and ask. I'm not going to go into that, but they're going to sell that at a higher price, which is going to send the price up from like 100 up to maybe 102. My camera died right in the middle of that, so let's go right back to it. So we were talking about supply and demand. So when more people wanted the Apple stock than was in supply, so there's more demand, 2,000 people wanted it, supply was 1,000, that means the price of $100 is going to end up going up because more people are willing to pay the price, so they're looking for the best buyer. Where in the other, so the price would go up to 105. But in the other instance, say that the supply was 2,000, people wanted to sell it, but the demand was only 1,000 people and the price was still 100, they're going to have to sell it at a lower price to get rid of these, so it'll go down to $95. So the big question though, what determines supply and demand? And the answer is a lot of different things, and it just depends on the stocks as well. But we will just talk about the S&P 500 as a whole. We're not going to talk about individual stocks. So what causes the supply, demand? So let's just talk about supply. Let's say the supply is the same. So supply stays stagnant. So there's 1,000 total shares. What changes the demand? And what makes people want to sell is the big question. So the demand, people want to go, like people like me and you want to go buy shares for the most part when there is good news. So good news. So people are holding long term or short term, if there's good news about the company, they're going to want to buy. So that's one reason the stock price could go up. More people want to buy. Because ultimately, if more people are buying than selling, that means the price will go up. Price will go up. So good news, people are buying. What else can do that? Good earnings. So something we haven't mentioned yet. Every quarter, companies will report their earnings. They'll release their 10Q, and they will say all the results. So more people want to buy if it's good earnings. So if they say this quarter we beat expectations, we did really, really well, more people are going to want to buy. Economic conditions is a big one. So economic conditions, and what I mean by that, I mean like gross domestic product. I'm talking about unemployment. You're talking about corporate earnings. So if there's good economic conditions, it's going to be good. And this is all going to make the price go up. So you want to be looking for these things, like we said in the other video. With the financial statements, if you're looking at balance sheet, income statement, things are looking good, revenues are going up, net profit, net income's going up, assets are going up. Like, that's going to want people to buy more. Because in theory, and what's real, is the more profit a company has, and if the shares stay the same, the price is going to go up as more people want it. So that's what we're looking for, but that's what determines price to go up. But on the other side of things, and there's a lot of other reasons as well, I'm just giving you guys the main ones. Bad news. So if there's bad news, people want to sell for the most part. So bad news, a bad result, E. coli comes out for Chipotle, bad news. People are going to want to sell. Bad earnings. So during the quarter, they decide that they performed really poorly. They're going to want to sell their shares, so the price is going to go down. Economic conditions say that GDP is falling extremely. They're going to want to sell, and that's going to make the price go down. So that's going to wrap up the fourth and final video of the stock market video. I enjoyed making all 4 parts. Hope you guys like and subscribe. Comment if you have any other questions, but this is going to be my first little series on some information. Down the road, I could definitely redo this and add more parts, get more into it while I get better at recording. So I'd like you guys to continue to follow me on the journey. If any other video suggestions that you have that you want me to talk about, just let me know. So I'll see you guys tomorrow with another video.